Howdy, folks. Welcome to Liberty Call. Today is Thursday, July 11th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a beautiful yet warm day here in Colorado. The sun is getting closer to the earth, I think. But yeah, it's toasty outside. So me and my boy Jake going to go and play some ball as soon as we're done here. So let's get to it. All right. Well, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. All right, let's get to today's numbers and see how everything turned out. All right, Dow Jones was up just 0.08%, 32 points, closed at 39,753. S&P 500 down 0.86%, 48 points, closed at 5585. NASDAQ down 1.92%, 358 points, closed at 18,288. The VIX was up 0.54% today. It's at 1292. Canada up 0.87. Brazil up 0.82. And Mexico up 0.28. All right, let's head over to Europe. Germany was up 0.72%. The UK up 0.36%. France up 0.71%. Netherlands down 0.38%. Spain up 0.89%. Italy up 0.03%. Switzerland up 0.92%. And Portugal up 0.89%. Russian exchanges bounced back. The MOEX is up 0.68% today. The RTSI up 0.52%. And the Asian markets from overnight, the Nikkei in Japan was up 1% even. Australia up 0.93%. New Zealand up 1.36%. In China, the Shanghai was up 1.06%. Shenzhen Component up 1.99%. China A50 up 0.55%. DJ Shanghai up 1.24%. Hang Seng up 2.06%. And the Taiwan weighted when it closed last on the 10th was up 0.45%. All right. So looks like the rest of the globe was in a pretty decent mood. It was here domestically, tech and, the broader market really, headed south for some reason. Not well, I mean, you would think it was good news. The Fed, we came out and got a CPI print, which we're going to talk about in a minute, that on the surface, you think that people in the market would think that's pretty good, but who knows? It's hard to understand where these idiots are, what they're thinking. All right, let's go ahead and get to the market recap. There it is. All right, global stock index falls with bond yields dollar after U.S. inflation data. All right, on Thursday, a global index of stocks slightly declined while bond yields dropped after U.S. inflation data increased the likelihood of interest rate cuts. The Japanese yen surged against the dollar, raising speculation of possible intervention by Japan to boost its currency. U.S. Treasury yields fell broadly as U.S. consumer prices unexpectedly dropped by 0.1% in June, following a stagnant May. This data, coupled with the Federal Reserve Chair Jerome Powell's recent testimony indicating that further positive data could justify rate cuts, reinforced the view that inflation is easing. Garrett Melson, portfolio strategist at Nataxis in Boston, highlighted the significance of CPI data, suggesting that it could lead the Fed to consider rate cuts potentially starting in September. Despite the encouraging inflation data, major Wall Street indexes fell due to a rotation of investments into lower-weighted interest rate-sensitive sectors like real estate and utilities, and away from technology, which had already seen significant gains this year. Additionally, disappointing earnings reports from PepsiCo and Delta Airlines added to the cautious sentiment ahead of U.S. bank earnings. Yeah, and I read an article earlier that went through the breakdown. It was on Zero Hedge, if you want to go and find it. That broke down the breakdown of losses in the different PepsiCo brands, as far as food, beverages, things like that. Also domestic versus international. So interesting little bit of detail there. The MSCI Global Stock Index decreased by 0.02% to 824.58, having earlier reached a record high. Europe's Stock 600 index closed up by 0.6%. In currency markets, the dollar weakened, with the yen gaining over 2% amid speculation of Japanese intervention to support its currency. The dollar index fell by 0.5% to 104.44, while the euro rose 0.33% to 108.66, and sterling increased by 0.52% to $1.29.12. U.S. Treasury yields dropped, with the 10-year note falling to 4.193% and the 30-year bond to 4.4043% and the 2-year note yield to 4.40%. 6.5067. As you can see, it is still inverted if you look at those across the yield curve. In commodities, oil prices edged higher following the inflation data. U.S. crude prices rose by 0.6% to $82.62 a barrel, and Brent increased by 0.4% to $85.40 a barrel. Spot gold prices surged by 1.91% to $24.16 an ounce, and U.S. gold futures gained 1.78 to $24.1440 an ounce, buoyed by the prospects of rate cuts. Also, silver was up about the same, almost 2% too. So they were both jumping this morning. All right, so that is the market recap for today. Let's go ahead and get a little deeper into the CPI numbers. The June CPI print came out today. Inflation in June came in softer than expected for the third consecutive month, marking the first outright monthly decline since the early months of the COVID-19 pandemic. This trend reinforces the Federal Reserve's confidence that inflation, currently running at 3% year over year, is gradually heading towards the 2% target. Okay, if you say so. Consequently, it increases the likelihood of short-term interest rate cuts beginning in September. Now, if I could stop here, I'd love to see some deflation, like where prices actually go below, they go down, as opposed to slowing down how much they're going up. I'd like to see them go downward. That'd be a good idea. All right, from mid-2022 to mid-2023, inflation showed significant progress, dropping from a peak of 9.1% in June of 22 to 3% in June of 2023. So we basically been treading water for a year. This progress has led many to believe the temporary pandemic-related inflation issues were resolving. However, inflation pressures resurfaced in the first quarter of this year, raising doubts about the Fed's ability to cut rates in 2024. Now it appears that inflation is resuming its downward trend, partly due to a lagged response to the decline in M2 money supply from early 2022. Actually, the M2 money supply is up 0.8% this year so far, so it's not going down like it had last year. All right. June's inflation report revealed that energy prices, which fell by 2%, played a significant role in holding down overall inflation. Gasoline prices in particular declined by 3.8%. Excluding volatile food and energy prices, core inflation rose by only 0.1%, the smallest increase since August of 21. A notable slowdown in housing rents contributed to this softness, with both tenant rents and imputed rental value of owner-occupied homes increased by just 0.3%. The supercore inflation, which excludes food, energy, other goods, and housing rents, declined by 0.1% in June, marking its first outright decline since August of 21. This is a positive sign for the Fed, as supercore inflation has been resilient despite rate hikes. Other categories showing declines include airfare, 5%, hotels, 2.5%, used vehicles, 1.5%, and new vehicles, negative 0.2%. In addition, initial unemployment claims fell by 17,000 to 222,000 last week, while continuing claims decreased by 4,000 to 1.852 million. Overall, this report supports the view that inflation is easing, potentially paving a way for future rate cuts by the Fed. All right. Good stuff. All right, let's get over to got an article here from Zero Hedge. It's titled Soft Landing or Hard Crash, The Hidden Dangers of Rate Cuts. Because everyone's begging for rate cuts. Do they understand what actually is going to occur once that happens? This was submitted by the QTR's Fringe Finance. All right. The author recently shared insights on macroeconomics and markets, highlighting two new long positions for the second half of 2024. Several negative catalysts remain: a threat, potential wars, a dire U.S. fiscal situation, and uncertainties surrounding the 2024 election. Despite widespread hope for a Federal Reserve rate cut to boost markets, history suggests rate cuts often precede market declines rather than rallies. Historically, market bottoms tend to follow Fed rate cuts. These cuts usually occur after the effects of previous hikes have permeated the economy, typically taking 18 to 24 months. The author acknowledges a previous misjudgment about the timing of bearish market movements, but emphasizes the potential for a significant market downturn following rate cuts. So, we're in more day. Most people think that, when they start cutting rates, the market's just going to explode. Well, based on historical patterns, it's actually quite the opposite. Markets go down after rates cut, and then you actually hit that bottom. Let's see here. The macroeconomic backdrop continues to worsen, with the Fed in a quantitative tightening phase. Bad news no longer translates to good news for markets. Regional banking and commercial real estate sectors are showing signs of strain. Retail retail earnings reflect consumers being financially stretched, and the unemployment rate has increased to 4.1%, the highest since November of 21. The New York Fed reports that household debt increased by 184 billion in the first quarter of 2024, with rising credit card delinquencies. Approximately 18% of borrowers are using at least 90% of their credit card limits, indicating financial distress. Rising debt delinquencies suggest borrowers are struggling to meet obligations, which could lead to liquidity constraints for financial institutions. This might result in tighter lending criteria and higher interest rates, reducing consumer spending and business investments. Consequently, lowering earnings and reducing revenue could lead to stock price declines. Even with a potential Fed pause or rate cuts, history indicates that markets may not respond positively immediately. Instead, stocks could fall before finding a bottom in subsequent quarters or years. Therefore, rate cuts should not be seen as an immediate buy signal for stocks. As a cautionary note, it is essential to mind the gap between rate cuts and market bottoms. All right. So again, be careful out there, folks. One last article here has to do with the financial disaster we have here domestically. U.S. spent a record $140 billion on debt interest in June, 30% of all tax revenues. So 1 out of every $3 that you pay in taxes just goes to pay in the interest. Awesome, isn't it? All right, in June, the U.S. budget deficit stood at $66 billion, significantly lower than market expectations of $83 billion and substantially less than the $228 billion deficit from a year ago. This smaller than expected deficit helped reduce the cumulative year-to-date deficit to $1.268 trillion. Oh, nothing. Slightly below the $1.393 trillion deficit for the same period last year. However, this improvement is superficial. The underlying issue remains the U.S. continues to spend significantly more than it generates in tax revenues. A deeper examination reveals that the country's financial health is still precarious, primarily due to soaring costs of servicing its national debt. Interest on the U.S. debt has become a critical concern. In April, it was predicted that interest payments, which were the second largest government expenditure at $1.1 trillion, would surpass Social Security to become the largest U.S. expense by the end of 2024, reaching $1.6 trillion and $1.7 trillion by April of 2025. This forecast seems on track, as recent data shows the U.S. spent $140 billion on debt interest in June alone, the highest monthly interest outlay on record. Awesome. Hey, we're hitting records. Isn't that good? Oh, wait, this is bad news. Year to date, the U.S. has spent $868 billion on debt interest, and it's projected to hit $1.144 trillion for the entire year. The $140 billion spent in June represents over 30% of all U.S. receipts, mainly taxes, for that month. This alarming figure underscores the unsustainable nature of the current fiscal trajectory, pushing the country closer to a financial tipping point, or a Minsky moment, where debt levels become unmanageable and trigger a crisis. In summary, despite a seemingly favorable budget deficit for June, the U.S. faces severe fiscal challenges due to its escalating debt and interest costs. This scenario highlights the urgent need for fiscal reforms to address the growing imbalance between government spending and revenue generation. The people in Washington just blame rich people for not paying their fair share. I mean, even though rich people pay all the taxes. I mean, if you make probably over $80,000, I think you're in like the top 10% of income earners in the United States. You're the ones paying all the money, or paying all the taxes for the government. Everybody under that, you really don't pay that much into it. And, quite frankly, if you get a refund back every year, you're not contributing to the system. So anyways, or especially if you get back more than you put in, you're definitely not contributing to the system. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope everyone out there has a wonderful evening, and I shall talk to you all again next time. Adios.